Welcome to Electrified. It's your host, Dylan Loomis. So we're definitely going to nerd out with some economics in this one, but with what the Federal Reserve has been doing, it has become increasingly relevant because it is an actual fact that 26% of the entire M2 money supply has been created in 1 year. In November of 2019, the M2 money supply, which is checking accounts, savings accounts, money market accounts, and circulating cash, was $15 trillion. Fast forward 12 months to November of 2020 and that number hit 19 trillion. So the Federal Reserve printed $4 trillion in 12 months. But this has created a problem because now people are taking this anecdote and shouting about things like hyperinflation, the stock market's in a bubble, and everything along those lines. So the question becomes, are they right? And where is the truth in this whole situation? But to understand the reality of what's going on and what this might mean for Tesla stock now and going forward, we have to actually understand what quantitative easing, money printing, and all of these things actually mean. Because the fact of the matter is, most of the money in existence does not come from quantitative easing, or QE as I'll refer to it. It actually comes from private banks making loans to people like you and me and small businesses. And just real quick so you know, QE is very different than helicopter money, which you may have heard it referred to. Helicopter money you can think of more like a stimulus check or a helicopter flying over, just dropping money directly to people like a stimulus check. Quantitative easing is very different. It is not the same, and by the end of this, you will understand why. So, as I mentioned, every single day, money is being created out of thin air at private banks where they are creating these loans to people and businesses. And the only constraint to this money printing is the bank's ability to make a profit. So, of course, this comes down to the borrower and their credit rating and all of those things. But if the bank thinks that they can profitably make a loan, they will make that loan. So the actual driving force behind money printing or money creation is the demand for these loans from the consumer point of view. And what is one of the main drivers to people wanting to borrow money is interest rates. The lower the interest rates, the more likely people are to borrow money because it's cheaper to do so, as is the case right now, as interest rates are historically low. But at this point, I think it's crucial I explain quickly what overnight lending is. You may have heard the term overnight lending rates. So think about it like this. Private banks all have net inflows and outflows every single day. So if at the end of each day, more money has left that one bank than has come in, they're basically going to square up with the central bank, and they then clear these differences with the central bank reserves. So this is called borrowing in the overnight lending market. And as you would imagine, for these private banks to borrow money from these central banks' reserves, there is an interest rate involved, and this interest rate is very important. If that's higher, ultimately the private banks will have to charge their customers higher rates to borrow money. And thus, this is a rate that the central banks and the Federal Reserve will try to manipulate, and how successful they are in doing so you will see by the end of this episode. But that is what they're trying to do when they are printing money in this fashion. Basically, the central banks can print money out of thin air and create bank reserves that these private banks will then borrow. So essentially what the central bank is doing in this instance is just managing the liquidity of these overnight loans. And so you can think of the central bank like a backstop because they are the lender of last resort, managing the liquidity of that market through an operation called open market operations, or OMO. Ultimately, these open market operations, the goal is just to influence the demand for loans from these private banks. So open market operations are just when the central bank manages these bank reserves by either adding to or taking away from the supply in the private banking system. So if they're attempting to decrease the overnight lending rate, they would essentially create or print these bank reserves and increase the liquidity, and they basically are buying short-term government securities or corporate bonds from the private banking sector. But here's a critical point. When this happens, it is literally just an asset swap. What's really going on is the central bank is giving these private banks more bank reserves, and in return, these private banks are giving the central bank short-term government securities. So they're swapping assets. So nothing on the private bank's actual balance sheet is changing. It's literally just a composition of the assets that they have. So these open market operations are not like literally just printing currency randomly. they're actually creating bank reserves and then swapping them with the private banking system in an attempt to manipulate the short-term interest rates in order to increase the borrowing demand from the consumer and small businesses. And so the thought process is actually pretty straightforward. It goes like this. If the central bank adds these short-term securities to their balance sheet, it will increase the demand and thus drive up the price, which, if you're familiar with interest rates and bonds, will drive down the yield or the interest rate of those bonds and thus stimulate more lending. And these open market operations are conventional, meaning they're super normal, they happen all the time. So whether you believe it or not, money is being printed and created every single day by these open market operations and private banks making loans. But here is where things get interesting. What can they do if interest rates are already at or near zero as they are today? Well, enter QE or quantitative easing, and this is an unconventional monetary policy. So Japan was really the first example we had of this on a global scale, as they started QE back in 2001, and they've had a lot of problems with deflation, but that's a topic for another video. And the US, we really started doing this back in 2008 with a global financial crisis. And the thing is QE is very similar to open market operations. The only real difference is that with QE, they're buying longer term securities and in much larger amounts. And QE is really what most people are referring to when they're talking about money printing in general, and you see this type of video going around. But a key takeaway is that quantitative easing is still just an asset swap. It's a situation where the central banks are printing these bank reserves or creating them out of thin air, but they then use these bank reserves to purchase these longer term securities like government bonds and corporate bonds from the private sector banks. And the goal of this quantitative easing is similar to the open market operations, but it's to drive down the long-term interest rates with the exact same theory. If they own these longer-term securities on their balance sheet, then the demand will increase for those in the private market sector, driving down the interest rates in the long term because they're buying longer-term securities. But once again, this is just an asset swap that does not change the balance sheet of these private sector banks. It just changes the composition of the assets they own in an attempt to encourage more economic activity in the form of borrowing. So look. I promise I'm gonna land the plane soon, so just stick with me. But it's this low rate environment and quantitative easing where people perceive that it's going to be good for the stock market. There's less risk, the borrowing environment is very favorable, so people are assuming better economic outcomes. And there is some evidence, as this 2014 paper called Evaluating Asset Market Effects of Unconventional Monetary Policy showed that a 25 basis point drop in the 10-year Treasury yield resulted in a stock price increase of 0.7%. So 0.7%, whoop-de-doo, yeah, it's obviously not that impactful, which is kind of the ultimate point of this video. And the impact of this becomes even less substantial when rates are already at or near zero as they are today. So basically, these money printing, quantitative easing, open market operation efforts are not that impactful when interest rates are already at or near zero, or even when they're high. There is much debate around how influential these operations really are. So your first big takeaway, to say that the Federal Reserve printing money, doing quantitative easing is single-handedly propping up the stock market is a massive stretch and one I would definitely stay away from. There are so many factors that influence the price of the stock market. Picking one, like this one in particular, and saying that it's driving the stock market performance is not accurate and not something you should do. This 2010 paper on money reserves and transmission of monetary policy, does the money multiplier exist? It shows that changes in reserves are unrelated to changes in lending, and open market operations do not have a direct impact on lending. We conclude that the textbook treatment of money in the transmission mechanism can be rejected. Specifically, our results indicate that bank loan supply does not respond to changes in monetary supply policy through a bank lending channel, no matter how we group the banks. So remember that actual money creation, most of it comes from private banks making loans to consumers and businesses. And those loans are only going to happen if there is a demand on the part of the consumer and the businesses. So it's not that much of a stretch to say that actual money printing or money creation stems from the demand for loans from consumers and businesses. So this notion of money printing leading to inflation and hyperinflation is really misguided. And when you look at Japan, their worry is deflation. So that's why it's so crucial to understand how these things actually work instead of just reading headlines and then making opinions in a matter of seconds. And so a big takeaway that I hope you guys walk away with this from is that you should not be making your investment decisions based on any one factor, especially this one in terms of quantitative easing and printing money. Yes, it may have some level of impact, but it's probably not anywhere near the impact that most people think that it has, because the way these things actually play out and the logistics of it is not what most people think. So there are just way too many factors in play for the prices of the stock market, and some of these studies show that QE doesn't have that much impact on the price of stocks. And one last point that I really want to make is when you talk about inflation, you have to nuance that out, right? There are actually three types of inflation. You have monetary inflation, you have asset price inflation, and then you have the CPI, or the Consumer Price Index. So monetary inflation is basically what we just got done explaining. Quantitative easing, helicopter money, open market operations, all of these things increase the monetary supply. Then you have asset price inflation, which is exactly what it sounds like when the prices of assets, so stocks, bonds, real estate, gold, Bitcoin, when all of these prices appreciate. This can actually be thought of like a CPI for the wealthy because it's typically the wealthy people that own these stocks that in the long run tend to appreciate in value. And then third is the CPI, or the Consumer Price Index. Now, this is generally what most people are referring to when they say inflation as a broad term, and it's basically just a basket of goods that people slap a price on and then track over time. The problem with this, though, is that there's no one basket of goods that's going to make sense for one person that lives in Beverly Hills and another person that lives in poverty somewhere else. It's just those two people are not buying the same basket of goods, so that metric is really just an estimate at best. So the next time you're talking about inflation, just make sure you actually know what specifically you're referring to. Now, some of you may be sitting there thinking, well, stimulus checks are different and that could be propping up the stock market. So there is an argument to be made there, right? Stimulus checks are the helicopter money. It's very different than QE, so it's bypassing the banking system and going direct to consumers. They can then use that money to buy stocks and do whatever they want, but this is where you need to look at the velocity of money. So if you look at this chart, you can see that the velocity of money is historically low. All this really means is that people are indeed saving, investing, and paying down debt instead of actually buying goods or services. So when you hear velocity of money, that's all that it means. When people buy goods and services and stimulate the economy, that means the velocity of money is going up. If they're saving or investing or paying down debt, not actually buying stuff, then the velocity of money comes down, which, as that chart shows, that's exactly what's happening. They're doing the latter. So in theory, they could be buying assets and buying stocks, but in the grand scheme of things, once again, you cannot look at only one metric. This stuff all works together. So are we in a bubble? Well, the truth is, I don't know, you don't know, and nobody knows. You can't know until it's been popped. But the point of this video was to help hopefully give you a little bit more education around these topics and to help you to know that these conversations need to be far more nuanced than we typically see on Twitter and even on YouTube. So the next time you see a statement like, oh, the Fed's printing money and hyperinflation's coming, Bitcoin's going to the moon, we're in a bubble, all of these things, just remember to slow down, think it through, and maybe not listen to that person that's saying those things and making those types of statements. Because the fact is, it's just a lot more complicated than that. And so since you came this far, should you be worried about your Tesla stock? Absolutely not. Does this money printing have an impact on Tesla? Maybe. Nobody really knows. If anything, though, it's minor. As we know, Tesla is in a league of their own. Absolutely long-term buy and hold, nothing wrong with that. No matter what the government tries to do with these interest rates and the money supply, Tesla is going to crush the game. There's going to be ups and downs, but in the long run, just keep hodling and don't look back. But thank you guys for watching. Please like the video if you did. Consider subscribing for more content like this. And with that, I look forward to seeing you in the next video. I hope that you have a great day. Up, it borrow these open market exchange forward in and of a more to in they can